This video will go through lesson 11.1. We're talking about accounting for purchases, transactions using a general journal. There are 3 objectives. You need to be able to explain the purpose of a general journal. You need to be able to account for purchases, returns, and allowances. And you need to be able to post a general journal to the accounts payable ledger and general ledger. So first, they're just giving us some terms, some definitions. A general journal, which we've been working with, is the journal with 2 amount columns in which all kinds of entries can be recorded. A special journal is going to be where very specific transactions are going to be recorded. So here it just says not every transaction can be recorded in a special journal. They're showing us an example of a memorandum that we would maybe see when we buy supplies on account. So we can see the number of the memorandum, we can see the date of the memorandum, and then it's just a simple description as to what that memorandum was for. So attached invoice is for supplies bought on account. So here's our transaction. Bought store supplies on account from Estes Supply, 165.25, memorandum number 42. This is not a new transaction to us. We're going to debit our supplies store for $165.25. We're going to credit accounts payable for $165.25. We're also, they don't have a T account for it, but we're also going to be crediting that Estes Supply. So in our general journal, here is our debit to our supplies store. And then we have our credit to accounts payable Estes Supply. Now, the reason that there's this line that's through our post reference column is because when we are ready to post, we are actually going to be posting that credit of $165.25 to 2 separate accounts. See how there's that slash in between. So accounts payable is the controlling account, and Estes Supply is going to be that vendor. Okay. So we are going to credit accounts payable, and then we will credit Estes Supply as well. Credit allowed for the purchase supply of returned merchandise, resulting in a decrease in the customer's account payable to the vendor. That would be called a purchases return. A purchases allowance is credit allowed for part of the purchase price of merchandise that is not returned, resulting in a decrease in the customer's account payable to the vendor. So we are probably most familiar with a purchases return. Okay, so a customer buys something, or in this case, when we're doing a purchases, we bought something and we decided to return it. We get that price back because we've returned that merchandise. A purchase allowance, though, is almost kind of like a discount. Maybe we received those goods and there was a chip in the good, or it was the wrong color than we ordered, or something was broken on it. And we might not actually return that good, but instead we're going to get an allowance. So it's that decrease in our account payable. The form that we would use to prepare would be a debit memorandum. So it's a form prepared by the customer showing the price deduction taken by the customer for a return or an allowance. So here we see a debit memorandum. We're going to see the information. So here's like our debit memorandum number. We see who our vendor is, and then we see what was given as an allowance or for a return. So December 8th, it says that we returned merchandise to Mobley Tools, $43.90, covering purchase invoice number 528, debit memorandum number 38. Here's going to be what our T accounts look like. When we see this purchase invoice number in here, this is just saying this was our original purchase. And so we are returning merchandise from this purchase invoice. We want to make sure that we're putting that in there so that we can see any evidence that's relating to that transaction. But this debit memorandum number 38 is our current source document that we're going to be using. So when we returned that merchandise to Mobley Tools, what happens now is we are going to decrease the amount that we owe to Mobley Tools because we've returned some merchandise. So we're going to debit their account, accounts payable / Mobley Tools. Then we have in our source document, we have that slash in there again. That's just showing that we are going to be posting that debit twice. We'll post it once to our accounts payable, and then we'll post it once again to Mobley Tools. And then the account that we're going to credit is our purchases, returns, and allowances. So it doesn't matter if it's a return or if it's an allowance, it's always going to be put into that same account: purchases, returns, and allowances. Now they're showing us then our posting. And so here what they're doing first is they are posting from the general ledger to the accounts payable ledger. So it's specifically then to those two vendors here. So notice we only have those vendor numbers in the bottom of that post reference because we're just posting to the accounts payable ledger at this time. So first goes in our date, then we're going to put in our post reference. So G12 stands for General Journal, page 12. We have, in this case, a credit of $165.25. In the second one, we have a debit that we're putting into that account. Then we need to find our new balance. In this one, we have a credit previous balance, and then we're crediting, so we're going to add to find our new balance. In this one, we have a credit previous balance, and then we're debiting that account, so we are going to subtract to find our new balance. So 2 credits we add, 2 debits we would add, but a credit and a debit we would subtract. That last step then is bringing that vendor number up to our post reference column. Once we're then done posting to our accounts payable ledger, then we would post to our general ledger. And so our general ledger is going to be all of our permanent accounts that we're going to see, or all of our regular accounts. So like supply store and our accounts payable is what we're seeing here. So again, we start with our date. G12 stands for General Journal, page 12. We post in that debit here. Here we have a credit that we're posting. We're finding our new balance. We have 2 debits here, so we're adding. This one we have 2 credits, so we're adding again. And then the last thing, this should not say vendor name, a number, this should say account number. We're taking that account number up to our post reference column. Okay, number 1, I do want you to actually quiz yourself on this. Okay, so if you do not know the answers to these questions, you might want to go back and do a little more reviewing. Number 1, when is a transaction recorded in a general journal? When the transaction cannot be recorded in a special journal. So if it can't fit into a special journal, then it goes into our general journal. Number 2, when is the equality of debits and credits proved for a general journal? After each general journal entry, we should be checking. Really, that should be accounting in general. After every transaction, after every entry that we make, we should be checking debits and credits. It's just in our general journal, we don't total that up, and so we don't check at the end to make sure that debits and credits equal. Number 3, what is a primary difference between a purchases return and a purchases allowance? A purchases return is going to be credit that is allowed for the purchase price of returned merchandise. A purchases allowance, however, is credit allowed for part of the purchase price of merchandise that is not returned. So they give some examples here of units that are damaged, or maybe they're still usable, but we wanted a different color, or it's chipped, like I said before, or maybe it was a different quality than we thought we ordered, and so they're giving us a discount for that, or an allowance. Number 4, if purchases, returns, and allowances decrease the value of purchases, then why are returns and allowances credited to a separate account? That's a great question. And so why wouldn't we just decrease purchases? If we were to just decrease purchases, it would look like we never made that purchase. And that's not what we want to do. The other part of this is we want to keep track. How much returns and allowances are we making? How many things are we returning or getting allowances for? So better information is provided if purchases, returns, and allowances are credited to a separate account. A business can then track the amount of purchases, returns, and allowances in a fiscal period to evaluate the efficiency of its purchasing activities. Okay, that was the end of 11.1 lecture. You can now go on to the work together video.